Our company is John Deere and Co. My name is Josie Curran.
I'm Miles Walker.
I'm Anthony Gelzer.
I'm JB Potts.
And I'm Evan McLean.
Welcome to our presentation. Here is an overview of what we will be discussing today. As a group, we have found issues with Deere's right to repair, DI, and declining demand. New tariffs are also an issue for the company. We will be discussing the external and internal assessment, strategic choice, SWOT analysis table, generic strategy, and our corporate level strategy. Our strengths and opportunities are selling used equipment, brand loyalty, global presence. Some external issues are declining demand and tariffs. And for our problem statement, Deere is facing increasing supply chain instability, new tariffs, and decreasing demand, along with repair policies that are causing legal action. Here's a little company overview. Our company is Deere & Co. The industry is the heavy construction industry. Some services we have are precision construction technology, construction product support, right to repair, and a few products that we have are backhoes, dozers, and used equipment.
Deere's and Company CEO is John May, who joined Deere in 1997, originally as a management consultant. He worked his way up the ranks, including managing the construction and forestry division before acquiring the CEO position in November of 2019, and then the chairman of the board of directors in May of 2020. In the CEO position, May manages and directs over 75,000 employees spanning all over the world in over 30 countries. To do this, May focuses on the smart industrial strategy he created in order to prioritize production systems, technology slack, and lifestyle solutions, which allows them to innovate and maintain better than the competition. Doing this, May has pushed the company to reach market capitalization of $100 billion for the first time in company history and revenue of $61 billion in 2023. Now I'll be handing it back to Josie to talk about Deere's mission and vision.
The mission statement for John Deere is enable life to leap forward. This mission statement is Deere's promise to sustainability by providing solutions and support for customers when using Deere's construction equipment. Deere's vision statement is we run so life can leap forward. This vision statement encompasses Deere's dedication to making products and services that support customers for generations. The main goal of Deere's mission and vision is to deliver cutting-edge, intelligent, and networked machinery that transforms the construction industry while emphasizing sustainability and moral corporate conduct that will enable clients to protect their land, lives, and means of subsistence. Moving on to strategic goals and objectives. The objective growth plan is to create solutions that provide clients with financial and sustainable results. The main objective is to increase the technologies used for equipment in the construction industry, to expand solutions as a service business model, and also to improve customer profitability through efficiency and reduced costs. Below is the growth plan, which is a quote that demonstrates Deere's plan to grow, coming directly from the company's at-a-glance release. And here is a graphic of the internal environment for John Deere. Some notable sections of this graph is the total revenue and how it has declined 16% from 2023 to 2024. The only increase for Deere from 2023 to 2024 was SGA, which increased by 5.6%. Now handing it off to Evan.
So market segments for Deere is construction and precision agriculture, small ag and turf, construction and forestry, and their financial services. As we can see, from 23 to 24, the total revenue did decrease, but our percentage of profit or revenue coming from construction and forestry did increase, which is nice to see from John Deere. Looking at the bottom, we can see that the US and Canada have a slowing growth in construction equipment, but the global area is flat, meaning that around the world there's opportunities in the road building industry, which is a very strong point for us. For supply chains and tariffs, John Deere is incredibly concerned about this. With most of their stuff that's being produced in the U.S. being sold in the U.S., whatever they're selling in any area is being produced in that area. Some main things with the Trump tariffs is these TSM semiconductors, which is being imported a lot from China, has now been increased its production in the US, meaning that we're going to have lower tariffs on that. And the other thing is Trump talks a lot about their Mexico plant, but John Deere only makes about 4% of its products in Mexico that it sells in the US.
Right to repair. What is it? The complaint accuses Deere of creating and maintaining a repair service monopoly and engaging in anti-competitive business practices that interfere with the farmer's right to repair. The Deere agricultural equipment and construction equipment is in violation of federal and state antitrust laws. When we go to look at the pest, for P, the political, some things you have to worry about are global trade war may impact agricultural and equipment business. Growth, the economic state is strong market conditions are driving the demand. Sociological, global population is growing. Population is growing in size and affluence. Technological advancements for competitive advantages. When we get to the five forces, for threat of entry is moderate to low. The machinery produced by John Deere and competitors are heavy, and the capital requirements for setting up the infrastructure is high. Buyer power is moderate. The customer cannot integrate backwards. They cannot produce these products by themselves. They need the company. Supplier power is moderate. The suppliers are readily available and not concentrated in one geographic area. The threat of substitutes is moderate. For large farms and construction sites, using manual tools is highly impractical. So that cannot really be considered a substitute. Rivalry is high. The competitors include Caterpillar, Komatsu, XCMG. The industry is a niche market and the target market is small. So I will hand it over to Josie to talk about the SWOT.
To start off with, there will be the strengths of John Deere. As shown, brand reputation, technological innovation, and diverse portfolio are all strengths. Deere's well-diversified brand portfolio helps it stand out as a standard for excellence in the construction industry and improve its brand value and top-line performance. When it comes to global presence, this is a strength for Deere because having operations in multiple markets eliminates the risk that comes with focusing on one market in particular. Next are the weaknesses, which are lack of expansion in emerging markets and increasing debt. Deere as a firm has an increasing amount of debt, which could have an impact on the overall performance of the company. Having a large sum of debt could end up taking away from the company's yearly earnings. Investors may also be concerned about this, which might make it challenging for the business to acquire money from the market on advantageous terms. The opportunities are new product launches, partnerships, new global opportunities, and environmental regulations. One big opportunity for the industry is the new product launches. In 2023, companies started to introduce new products for the construction industry. Also, the industry is also slowly introducing more environmentally friendly equipment. The external environment threats are changes in technology, competition in the industry, and prices of raw materials. The construction industry is highly competitive, making it difficult to maintain a dominant position in the market. Also, the prices of raw materials are a threat to the industry. The raw materials that the industry uses are highly dependent on the market when it comes to pricing. Moving to Evan for the income statement.
When we look at the income statement, um, we're really happy to see the total net sales and revenue increase by 45% from 2020 to 2024. And even during this time, we have the even larger spike in 23 for net sales of up to $55 billion, which is really nice to see. Our R&D research spending increased 39% from 2020 to 2024, showing that we're trying to be innovative and stay ahead of the curve. And during all this time, we did a really good job controlling costs with the increase in sales, going from about 85% cost from our sales down to about 82% in 2024. So really good job there. When we look at the balance sheet, we can see a very large cash reserve, which is nice for the incoming possible legal action. Total assets increased about 43% from 2020 to 2024. A lot of that came from financing receivables, which is a new increase of about $20 billion. Another big part of that is the assets held for sale, which is a new addition in 2024, along with the prepaid pension. And then inventory has steadily increased the whole time. While doing this, they only increased their liabilities by 36%, which is nice for them. But to do this, they participated in a lot of stock buyback, and that's very evident. As you can see, a huge increase in the amount of stock held in Treasury. And during this whole period, they increased their retained earnings by 73%, which shows that they've got a strong financial position. For ratios here, for the operating ones, we can see that we're very strongly outperforming everyone in operating margin and gross margin. We do a very good job with our low SGA, below the rest of the competition, even while having a higher inventory turnover, and a lower inventory percentage of total assets. And then our ROE is above the industry average. Getting that return on equity is important. For liquidity, we're not in a strong position with current and quick ratios below peers and below 1, which is not strong. But our long-term debt is above the industry average, but still a kind of weak point, even though it's above the industry average.
For leadership, corporate governance, and culture, as mentioned previously, John May is CEO and chairman of the board. May has been inside Deere for almost 30 years with backgrounds in accounting and management, allowing for him to add crucial knowledge and experience to the leadership team in order to keep the company moving forward. Along with May, many others of the corporate leadership team started in Deere many years ago, allowing for them all to truly understand the ins and outs of the company, helping it run smoothly and efficiently. The 5 core values of Deere include integrity, quality, humanity, commitment, and innovation. meaning Deere strives to be the industry leader in innovative technologies and use this competitive advantage in order to improve the lives of the consumer, the community, and the environment around us. Now I'll hand it to Miles to discuss our value chain.
Okay, the value chain, we have financial, quality, and availability. But first, for financial, John Deere's financial depends a lot on keeping the production costs low. They have to pay for things like material, labor, and equipment. So staying efficient helps them save money and boost some profits. Next, we have quality. They're also known for quality. Their tractors and machines are built to last, and customers trust them because of that. To keep that reputation, they use strict quality control during production. Last but not least, we have availability. Availability is key. John Deere relies on a complex supply chain to make sure products and materials show up on time. If there's a delay, it can slow down everything. Next, we will have the problem statement. Looking ahead, Deere has to deal with the impact of tariffs, which could cause supply chain challenges. They'll need to figure out how to manage these issues and keep things running smoothly. Next, on top of that, the company is also facing legal pressures to review its repair policies. There's been some controversy around who can fix their equipment, and that's something that have to address moving forward. Next, I'll be handing it off to Anthony.
All right. Our suggestions on how to solve the problem. We can start off with production and lowering productions of our new products. By doing this, we are forced to continue to sell our used inventory, which will reduce inventory that's sitting around and not necessarily being used. In order to sell off used inventory, our idea was to lower the financing interest rates, which will make the used products more desirable. Deere did this back in the financial crisis of 2008, lowering their interest rates to an average of 0.6%, allowing the company to continue operating and innovating. Then we'll move on to the next slide, which is how we create a competitive advantage. As I previously stated, we plan to lower production costs, sell off used inventory, and our financing. We can also use the Bauma Construction Trade Fair, which demonstrates our advanced technologies and kind of gives us our foot in the door and show what we can really do. We can also use our distributors, getting lower costs and creating our products and selling them lower than the competitor. We also will use our skilled software engineers to continue advancing our new technologies and staying ahead of the curve compared to our competitors. And then on to slide 25.
For research and development, this is a very strong point for John Deere. Over the past 5 years, they've spent $9.6 billion on research and development, and they've increased their spending about 40% during that 5 years. So more of that 9.6 billion coming at the 23-24 mark. We're well above the peer average of R&D for total assets, and that's really good for us since our point is innovation and staying ahead of the curve. Our focuses right now for R&D are autonomous machinery, and you can see that in the middle one with our autonomous sprayer, our precision agriculture, and our smart equipment, and especially our new road equipment line that you can see from our subsidiary Witherspoon or Withergreen Group. So now we can control the whole process from start to finish for the road construction, which is a really good spot. A good opportunity here for us is to get interns in the door because they're lower cost, and then you can start to build that culture by creating a good culture from their start to their finish, so that they want to stay a part of the company for a long time and keep it strong and keep it growing.
Okay, next we have the outcome. As a group, we picked the four best outcomes to us. So first, we got sustainable competitive advantage, greater market share, lowering inventory, and last but not least, improving income and cash flow. And we just want to thank you for listening.
And here are our references.